the lack of fundamental analysis. I mean, can we tie this to any historical event like the dot-com bubble that gives us a good example of how investors should try and guard against following the herd?
Dot-com is perfect. It's the one that everyone looks back at because you had the mania, the frenzy, people investing in these companies that they were convinced would change the world at these astronomically high valuations. Because you see other people investing and making money, and human nature being what it is, you want to join in that. And usually a lot of people end up joining too late. It's the same with a lot of other companies at early stages. They have huge growth and then it slows down and you've missed, if you like, the initial bounce really. And people are sort of want to be sucked in. The irony, of course, with dot-com is that eventually a lot of those companies did end up changing the world. It was just maybe 10 years later. And it was important to look at the valuations. I think the problem now is we talk about tech stocks and the strength we've seen over the last 5 years repeatedly with this sector. And people say it's dot-com all over again. But the world is so different now, and those companies are so different now. Most of them, the really big ones, are so much more profitable that there's a reason why they're so strong. This isn't dot-com. Everyone's looking for the next 2008 as well sometimes, and they see it perhaps in housing data or in car loans or indeed in central banks and their rate hikes. And they're saying this will cause the next 2008. It's important not to try and fixate on examples from history and look at the data you have in front of you.